Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. In last month's LONGWave, entitled An Earnings Recession, we discussed some of what we would be looking for in the 2022 Q2 earnings. They're now almost complete, and we need to draw some conclusions on what they both confirmed and revealed, at least so far. As such, I'd like to address the subjects listed here. 1. Our thinking prior to the Q2 earnings. 2. What we were looking for in the earnings and guidance calls. 3. What we learned and so far have confirmed. 4. What we now expect. And 5. Some overall related conclusions. What was central in our thinking prior to the Q2 earnings season was 1. Whether we were witnessing a potential consumer-led recession, and whether it may in fact be a harbinger of a potential secular change in the U.S. consumer. 2. Could we be witnessing a secular shift in interest rates, which have been falling for 40 years, which would be triggering a shift in consumer spending? 3rd, also very importantly, what was the significance of the dramatic difference in top-down versus bottom-up earnings estimates? Was this a consequence of a new inflationary period we have recently entered into? We need to consider that. As long-term investors, this chart best highlights why we were grappling with these possibilities. We have long talked about creditism at MATA-SII and have been ardent followers of those lenders applying that credit and where their source of funding was originating from and shifting to. While there are many different kinds of lenders, there are only 3 sources of funds they lend, which can best be categorized as 1. Savings, 2. Money creation, or 3. Credit creation. This approach is particularly useful in demonstrating that the economy is dependent on credit creation to fund economic growth rather than on savings. This chart illustrates this and why we think it is important. At the end of last year, savings had funded only 20% of all U.S. debt, whereas credit creation financed 53% of all the debt, with the Fed and other countries financing the rest through money creation. This is important because the heavy reliance on credit creation makes the economy particularly more sensitive to interest rates. This helps explain why GDP contracted in both the first and second quarter of this year, even though the Fed has only increased the federal funds rate to a range between 2.25 and 2.5 so far. With the Fed intent on continuing to hike interest rates aggressively, it also suggests that the U.S. economy could be in for a much harder landing than most economists are currently expecting. It is astonishing that the Federal Reserve has financed 10% of all the debt in the U.S. and that other countries have lent the United States nearly $15 trillion and thereby financing 17% of all the country's debt. How is the U.S. to grow GDP going forward and for corporate earnings to expand if U.S. credit creation continues to deteriorate? How high will interest rates have to rise to attract foreign investment, especially if inflation continues to be a problem? U.S. equity markets have steadily risen since the 70s, as this chart shows by the rising channel of the S&P 500 from the bottom left to the top right. Meanwhile, interest rates have mirrored this rise as they fell during most of that period, as shown by the gold-colored 10-year U.S. Treasury note yield line from the top left to bottom right. Consumers have been able to increase consumption, allowing the U.S. economy to become a 70% consumption economy. This in turn has sustained steady corporate earnings growth. The question is, how do rates fall further from the zero bound? And can the U.S. actually sustain being a 70% consumption economy? Especially when we consider we have a heavily indebted U.S. consumer facing higher rates and, most importantly, with falling real disposable income in a potential era of continued elevated inflation levels. Stocks are currently priced at historically low trailing earnings yields of 2 to 3%, which means we are currently willing to pay a very big price for earnings. You can see here that the S&P 500 trailing 10-year annualized returns are very cyclical, rising and falling over basically 10-year periods. If history is any indication, then we are at the cusp of entering another 10-year period of falling stock returns. This is signaled and illustrated here when we look again at the S&P 500 trailing 10-year earnings yield but compare it to the corresponding 10-year forward earnings. As we saw previously with trailing earnings at 2 to 3%, we should expect forward earnings to be historically low. The issue is that in an inflation era of high inflation, we can fully expect PE ratios to be under attack, which they have been since the first of the year. With U.S. CPI at over 9%, this historical chart suggests that market PE ratios of 10 to 15% are to be expected versus in the 20s, which we have become quite accustomed to. Stocks are likely to catch down to bond returns. Even if bond returns improve with the Fed pivoting from quantitative tightening to the resumption of quantitative easing, which the market is fully expecting to occur later this year or early in 2023. Our view going into Q2 earnings season is that we are on our way to approximately 3270 on the S&P 500 by Q3 or Q4, before reversing as the Fed comes off its quantitative tightening policy stance. However, as we stressed in last month's video, we felt a short-term counter rally was to be fully expected, even though earnings would be weak with concerning forward guidance. As we release this video, that is exactly what we've experienced by the circled WX leg of the WXY Elliott wave pattern we have been expecting on the way to the 3270 number. Once the counter rally is complete and we have reached the lower 3270 pivot area, we expect a strong rally to reach towards prior highs. Again, this will be a direct result of the Fed reversing from QT to QE. We expect to see QE on steroids as a serious recession unfolds and the Fed tries to arrest the ensuing damage. Longer term, our view continues to be expectations of falling returns throughout the remaining part of this decade. Markets returns will be reflective of falling U.S. standards of living as measured by household net worth as a percentage of disposable personal income. It will be a period of heightened inflation and intractable stagflation. That was our view going into Q2 earnings. So what were we looking for in the Q2 results to prove we were right or simply mistaken? We felt that answer would be about how the markets would handle the earnings in an era of higher inflation. This is something few have seen before, and it prompted us to do a lot of examination of similar periods in the 1970s, especially since we had also observed similar major distortions between top-down pricing and bottom-up PE pricing during that period. The first leg of our downward correction in the equity markets has been the result of a compression in PE ratios down globally in the MSCI World Index by over 28%, as shown here, and to below 16 in the S&P 500. This represents what investors are willing to pay for current earnings. The question that needs to be asked is whether an actual drop in corporate earnings is going to be the driver of the next big leg down in the equity markets, and specifically in the S&P 500. This chart shows a longer-term time frame for PE ratios for the S&P 500 large cap overlaid with recessions. Clearly, recessions drop both PE ratios and earnings. We considered carefully the impact of a potential recession and concluded that PE ratios are currently still only pricing in a moderate shorter-term 12 to 15-month U.S. recession. We believe it will be worse than that and more global in scope. This chart is intended to show how market price drawdowns in PE ratios during eras of high inflation versus low inflation compares to adjustments in corporate earnings per share. In times of low inflation, the right side of the chart, market capitalization, in black, as in the first half of 2022, went down by approximately 20% due to primarily valuation contraction as inflation rose, yield rose, and yet equity prices rose. Meanwhile, earnings per share, shown by the red line, has yet to come down. This is different to what happened during the dot-com bubble implosion in 2000 and 2021 and during the great financial crisis in 2007-2008, when earnings went down in line with falling market capitalization. Economic growth in these cases was priced to downside. There was no valuation contraction before earnings actually started coming down. Earnings shortfalls actually led the markets lower. This is substantially different to what we are seeing currently. To understand, we need to go back to the high inflation episodes that occurred in the 1970s on the left side of this chart. We see a much more similar dynamic to what we are seeing today. The 1973 episode, for example, saw prices coming down in anticipation of earnings coming down. However, when earnings per share did finally start to come down, the market pricing rebounded, having found a bottom. We see a similar dynamic in 1966 and 1989. Markets were driven a lot more by inflation than earnings. PEs were pricing in the coming earnings per share drop. When the drop in earnings per share came, the markets were already pricing in the expected Fed pivot. Clearly, in high inflation episodes, the market began to price in advance very significantly because this is a predictable dynamic. This is due to a lot of tightening delivering an economic slowdown. Investors are able to price in the slowdown in advance. This is something that can be calculated. In the 1989 episode, we can more clearly see that when rates and yields were rising, the market was pricing in slower economic growth. When inflation and yields peaked, prices reversed. So what were the S&P 500 drawdowns versus the S&P ratio drawdowns during these high inflation periods? Generally, they correlate, with the big exception being the high inflation period of 1973. However, we see in 1966 and today, the PE ratios were slightly larger than the S&P 500 drawdown, where the market bottomed in price prior to the earnings beginning to contract. So what happens when inflation exceeds 5 or 6%? What we have noticed is that high inflation eras help to temper falling earnings. Generally, earnings are driven by consumer spending. In this chart, we compare earnings per share drawdowns in red with real consumer spending in blue when one is falling and the other falls with it. The big exception in the 2000 dot-com bubble was driven by an overbought tech sector versus a slowdown in consumer spending. Everyone is currently expecting a collapse in consumer spending to trigger another massive leg down in earnings per share. We see on the left-hand side that during high inflation areas, a drop in consumer spending has a much smaller impact on falling earnings per share. In 1973, consumer spending fell by approximately 60%, yet earnings per share fell by only approximately 15%. Same in 1981, where consumer spending fell by approximately 40%, but earnings per share by only approximately 20%. The reason for that is because real consumer spending is real. It is already adjusted for inflation, whereas earnings per share is not. Inflation is a tailwind for earnings. They tend to go up in high inflation cycles. When recession is a fact, PE multiples trough. PEs typically trough at starts of a recession while earnings continue to fall. Price almost always front runs earnings per share. Price recovers about 6 to 9 months before earnings per share starts to rise and starts to decline rapidly just a few months before equities trough. So what we should look for is that when average earnings from the bottom up go negative, that the market's current leg should be expected to reverse. So what happened in Q2? The main highlights are, from an earnings scorecard, Q2 2022 with 87% so far of S&P companies reporting actual results. 75% of S&P 500 companies reported a positive earnings per share surprise, and 70% of the S&P companies reported a positive revenue surprise. Earnings growth. For Q2, the blended earnings growth rate for the S&P 500 is a positive 6.7%. If 6.7 is the actual growth rate for the quarter, it will mark the lowest earnings growth rate reported by the index since Q4 2020 at 4%, but it's still positive. Earnings guidance. For Q3, 42 S&P companies issued negative earnings per share guidance and 30 companies issued positive earnings per share guidance, pretty close to equal. From a valuation standpoint, the forward 12-month PE ratio for the S&P 500 is 17.5, still above our target of something south of 15%. This PE ratio is below the 5-year average of 18.6, but above the average of 17. The fact that earnings are still positive is the big tell. The market overall is not ready to reverse. It is still in an inflationary bear market. Until energy starts to reverse, this will be the case. What is critical to understand is that doesn't mean the bear market can't have a major counter rally. And as I will show in a moment, that counter rally can be large. However, until the bottom-up earnings go negative, the bear market can't be counted on to have been reversed. We're clearly close to a reversal, but have more downside, in our opinion, to go, and our 3270 target is still ahead. Q3 will be important. In addition, the market has not punished the S&P companies that have reported negative earnings per share surprises on average. Companies that have reported negative earnings surprises for Q2 have seen no price change on average 2 days before the earnings release through 2 days after the earnings release. This percentage is well above the 5-year average price decrease of 2.4% during this same window for companies reporting negative earnings surprises. In fact, if this is the final percentage for the quarter, it will mark the first time the index has not seen a negative price reaction on average to negative earnings per share surprises reported by the S&P 500 for a quarter since Q1 2009, which was 0.3%. So what can we now expect? Well, certainly a short-term bear market counter rally. However, the bear market is not over, as I said earlier, and we should expect a U.S. consumer-led recession to begin to unfold. Maybe it should be better called a cost of living recession, because that's what we're experiencing. The rapidly rising U.S. dollar will soon lead to and create a global credit event. That's our opinion. When the Fed signals a shift to rate hikes, then the U.S. dollar will weaken. That's what we need to be watching. U.S. dollar weakening will improve U.S. earnings and exports, which improve an earnings per share reversal. Yield curve inversion is currently signaling the Fed policy is definitely wrong and a recession is occurring, or at least close at hand. The near-term bear market counter rally can be expected to be relatively significant. Bear market rallies get larger as the bear market gets deeper and older, as we show here from 2000 to 2002, or from 2008 to 2009, as shown here. Both align with our Elliott wave WXY expectation chart we showed earlier. The rally in everything has eased financial conditions again, almost exactly the same amplitude of easing as we have seen 4 other times during this tightening cycle. We've seen this cyclical shift before with lower highs, tighter peaks to each easing subcycle, and lower lows, tighter tights, suggesting perhaps the Fed is well aware that tightening aggressively in one big batch will crush the market and the economy. So perhaps a more gently does it approach is more palatable, and judging by the amplitude of this easing subcycle, we should be facing another tightening leg down. I believe the current lift shown here will extend further than indicated before actually heading towards our 3270, and probably in multiple cycles as shown here. As Nomura, which follows us very closely, says, and I quote, "The trick here is this next few weeks window where the resumption of Fed speak could begin to lean back into the market's impulse easing of the financial conditions index. The last 4 times the spread between new orders and inventories in the ISM manufacturing index was this negative, the U.S. was already in a recession. The 2001, 1990-91, and 81-82 recessions never had readings this low. In other words, we still have further to go in this bear market. Americans' adjusted misery index is at its worst level since Jimmy Carter was president. And if everything was so not recession-like, why would consumer sentiment and presidential approval ratings be at record lows? So what can we conclude overall? The market is front-running the Fed's pivot, but it is likely too early. I suspect the Fed sees its policy as something to be like an L, a further major drop in financial assets, then a more protracted period of holding rates higher longer. We'll see if they have the fortitude for that when the politicians start screaming about the deepening and worsening recession. I'm kind of skeptical that they will have that fortitude, frankly, but at least this is what the Fed's current thinking is. A secular U.S. consumer recession is underway, or soon will be, and I feel should be better described, as I said earlier, a cost of living recession. The great unrest we are currently seeing with resignations, labor participation rates, early retirement, and the fallout from COVID employment mandates will bring sustained labor pressures. Labor pressures will keep wages elevated, which along with energy and food inflation will be bad for the markets overall. That is why we see 3 phases of inflation going forward. I've been writing about this in my recent newsletters. We've completed phase 1, but still have phase 2 and phase 3 ahead. Phase 2 will be primarily about an energy and extraction process crisis, while phase 2 will be about an unprecedented global food shortage. I refer you to the Matasi newsletters for more detail. These are all part of the unfolding commodity supercycle, which will go through the stages shown on the right. Again, as we outlined in our newsletter, we saw this inflation pattern twice before. Both episodes were when inflation was sustained at over that 5 to 6% threshold level. Most recently in the 70s, as shown on the left, with where we are in phase 1 on the right in comparison, and prior to that in the 1930s into World War II. Currently, the Federal Reserve isn't even in the ballpark of fighting inflation, never mind the issues associated with the drivers behind the commodity supercycle. The problems are only beginning, not behind us, as inflation, we suspect, in the near term begins to cyclically appear to be weakening. The last observation I leave you with is that you need to understand that the 3 phases of the commodity supercycle we've been writing about and inflation is a schematic. In actuality, the final market action ahead will appear as an M-top, and we've labeled the corresponding points 1, 2, and 3. Then we start a more protracted downward reduction in returns over the remaining part of this decade. As I always remind you in these videos, remember, politicians and central banks will print the money to solve any and all problems until such time as no one will take the money or it has become of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and global policy paralysis. I like to take a moment as a reminder, do not trade from any of these slides. They're for educational and discussion purposes only. As negative as these comments often are, there has seldom been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2022 turn out to be an outstanding investment year for you and your family. And I sincerely thank you for listening.